ETF versus stocks versus mutual funds, which is better? Are you confused about whether to invest in ETFs, individual stocks, or mutual funds? You're not alone with so many options. It's easy to feel overwhelmed in this video. We'll break down how each investment works, their pros and cons, and which one might fit your financial goals, whether you're a beginner, a long-term investor, or a hands-on trader by the end. You'll know exactly which path could help grow your wealth faster and smarter. So stay tuned, because this decision could literally change your financial future. Quick definitions. Let's start with the basics. What exactly are these three investment options? Stocks. When you buy a stock, you're buying a piece of ownership in a single company like Apple, Tesla, or Microsoft. Your returns depend on how well that company performs. Mutual funds. A mutual fund pools money from many investors and a professional manager picks the stocks or bonds for you. Think of it as a basket of investments you don't have to manage yourself. ETFs. Exchange-traded funds. An ETF is also a basket of stocks or bonds, but it trades on the stock exchange just like a single stock. It combines the diversification of mutual funds with the flexibility of stock suggestion. Show simple graphics of one stock, a mutual fund basket, and an ETF basket trading on an exchange. How they work. Now let's dig deeper into how they actually work. Stocks. Price moves minute to minute based on market demand. You can buy or sell instantly during market hours. High potential returns, but also higher risk if the company struggles. Mutual funds, managed by professionals. You invest money and the fund manager decides what to buy or sell. Prices update once per day. After the market closes, often have management fees called an expense ratio, and sometimes sales charges. ETFs. Track an index like the S&P 500, a sector like technology, or even commodities like gold. Trade all day like stocks, with generally lower fees than mutual funds. Great for passive investors who want diversification without paying high management costs. Comparing key factors, let's put them side by side on the most important factors investors care about. Risk and reward. Stocks. High reward potential. High volatility. Mutual funds. Lower volatility due to diversification, but slower growth. ETFs. Diversified like mutual funds, but can target specific risk levels. Costs and fees. Stocks. No annual fee, but you might pay brokerage commissions. Mutual funds. Expense ratios 0.5% to 2% yearly, plus potential sales fees. ETFs. Usually low expense ratios, as low as 0.03%, and no sales. Low liquidity and flexibility. Stocks. Buy, sell instantly during market hours. Mutual funds. Buy or sell only once per day at the closing price. ETFs. Trade anytime the market is open, just like stocks. Tax efficiency. Stocks. You control when to sell and realize gains. Mutual funds can distribute capital gains even if you don't sell. ETFs. Very tax efficient due to their in-kind creation redemption process. Suggestion. Create a comparison table with green check marks and red crosses. Who should choose what, so which is right for you? It depends on your style, goals, and risk tolerance. Choose stocks if you love researching companies, following market news, and are comfortable with risk. Great for investors who want potential high growth and don't mind volatility. Choose mutual funds if you prefer a completely hands-off approach and value professional management even if it costs more. Ideal for retirement accounts and people who don't want to trade actively. Choose ETFs if you want diversification. Low fees and flexibility. Perfect for beginners, long-term investors, and anyone who wants to set it and forget it. Real-life example. Let's say you have $10,000 to invest. Stock scenario. You put it all into Tesla. If Tesla doubles, you now have $20,000, but if it drops 50%, you're down to $5. Mutual fund scenario. You invest in a diversified mutual fund. You might average 6 to 8% per year, but pay 1% in fees. ETF scenario. You buy an S&P 500 ETF with a 0.05% fee. Historically, the S&P 500 has returned around 8 to 10% annually. This simple example shows how different your outcomes and risk can be in the end. There's no one-size-fits-all answer. ETFs are a great all-rounder for most investors. Stocks can deliver huge returns but require research and discipline. Mutual funds offer professional management but can be costlier. The best strategy? Diversify. Many successful investors combine these, holding a core of ETFs, a few individual stocks for growth, and maybe a mutual fund and a retirement account. If you found this breakdown helpful, hit the like button and share it with anyone confused about investing. And don't forget to subscribe to Knowledge Grid for more smart investing insights.